Welcome back, everyone. Season 2, Episode 8 of What Are Your Thoughts? I just wanted to start by saying thanks so much for the patience between Episode 7 and 8. We are doing a 12 to 18 month stint here in the greater New Orleans area, and we had to evacuate due to weather, and I was meeting clients on the road and things like that. So this got put on the back burner, but I'm back and I have some awesome topics to talk about today. The first one is going back to a topic from the episode 7, which we talked about federal income taxes. And I had a client meeting and the client was like, wait, really? I didn't know that's how these worked. And that was just this week. So I wanted to give a little bit of a refresher on that and discuss it. So looking at tax brackets from a federal standpoint, a lot of times in the media, you'll hear, oh, well, XYZ state will have a 50 or 55 or 60% top federal or top total taxation percentage towards its residents. So that's a combination of a lot of things: federal taxes, state taxes, local taxes, etc. Right now, I'm just going to focus on the federal taxes and talk about those brackets. So there are a few different brackets as it sits today. I know there's some legislation pending right now, but as it sits today, the first bracket is 10%, then it's 12, then 22, 24, 32 as far as a percentage of your income goes. So if you are married, filing jointly, and you have an income, I'm just going to use the most basic example just so I don't confuse folks like I think I did in the recent episode. If you have an income between 0 and 19,900, if you're married filing jointly, that is a 10% tax rate on a federal level. Now, at $19,901, so $1 over that 10% bracket, you will then get put into the 12% bracket. However, the point I want to make is that the entire $19,901 do not get taxed at 12. Only the $1 that you're over into that next bracket is taxed at that 12% metric. So it's a progressive system and it works that way all the way up. There's different bands of income that will decide on which dollar is taxed at what rate. So that's something to think about. And again, that's the difference between marginal and effective tax rates, right? Because some of your income will be taxed at 10, some of your income might be taxed at 12, some might be taxed at 22, some might be taxed at 24, 32, etc. So we want to make sure that we make that distinction that not every dollar is going to be taxed at 32 or 35 or whatever percentage that your top bracket is. It is progressive. So each band is taxed at a certain dollar amount. All right, buttoning that one up and moving on to the next topic, which I think is going to be really helpful for a ton of people. And this topic is stemmed from basically how the wife and I do our budgeting each month and how we set it up to just automate things moving forward. And it's a topic called reverse budgeting. So what is reverse budgeting and how does it contrast to like traditional budgeting? So another way to think about reverse budgeting is thinking about paying yourself first. So a lot of times I'll ask new prospects, and I've done this, going on 10 years now, asking them, what's the most important thing you've ever learned about money? And ever since day one, a lot of people have said, oh, pay yourself first. Like, okay, well, how do you do that and what does it mean? So a lot of people are familiar with traditional budgeting, so that'll be good to use as a comparison. So with traditional budgeting, you focus on expenses and really getting tedious and in the nitty gritty with expenses month to month, making sure you have a certain budget for fuel and a budget for restaurants and things like that. Reverse budgeting, by nature of the name, does the opposite. So rather than focusing on expenses, we're going to focus on savings first and set goals for those savings so that you can not feel guilty about spending whatever's left over. So part of it is traditional budgets are set up basically for failure in the sense that they're super hard to stick to. Life is just life. Like I was reading an example and it's like what if you rely on taxis or Ubers to get to your office, and it's really rainy in any given month, and you go $100 or $200 over on a specific budget? Or what if your friend asks you to go out to dinner and it's unexpected, and you you spend $100 on that? I mean, life is just unexpected. So we want to work with human nature, not against it. So the idea is really just to figure out how much you need to hit your savings goals, and do that first. Make the savings automatic, and then spend the remaining amount however you want. So, and I already used this example, but just thinking about it in a little bit more, the goal again is to just track savings rather than expenses. And it's good in the sense that reverse budgeting requires little maintenance month to month. Obviously, there is some time required up front to set up the automations, and to discover and write down or put in your phone different goals and things like that. But as far as like step-by-step process of how to do this and why it makes sense, here is the order that you would take to set things up. And I'll also go through at the end how or we, I should say now, structure our budgeting. So the first step is to basically take a look at what your income is, as far as even gross income, net income, and what you're currently spending. So things that you have to spend each month: fixed expenses, rent, mortgage, even the variable expenses that are coming each month, like utilities, fuel for your vehicle, things like that. Write those down and just get a feel for where you're at. And then after that, write down financial goals. So you could have a financial goal to max out your IRA, Roth IRA, or backdoor IRA, whatever you may do. And you want to say, okay, if each month, if the max is $6,000, that means $250 per pay period, or $500 a month. However it works for you. I mean, you could do weekly, you could do whatever works for you. But the idea is that gets treated as an expense, and that gets done immediately. Like if you get paid on the 15th and 30th, that transfer into your investment account happens on the 16th and the 1st, right? Because that gets it out of your account. You feel good that you saved that money, and then you do not have to feel guilty about spending what's left. So if we continue with these goals, you might have a goal of, saving $2,000 a year for a vacation, or saving, for a down payment on a home. And you can do this by setting either a dollar amount or set a percentage amount, right? Like a classic percentage that could be used might be 20% of your income you want to save, and that could include your 401k savings at work. So doing the math to figure that out. So 20% savings, 50% for expenses like rent, mortgage, utilities, all your expenses, and then 30% for whatever you want. And that can always get changed, right? You can always tweak these numbers and change as you move along in your, goals, to basically have some peace of mind each month as far as your cash flow goes. And how we would do that from just a logistical standpoint is doing it with separate accounts and doing it with automation. So I know at our bank, or I like to use credit unions, but our bank, we have separate sub accounts. So money comes in every month or every couple of weeks. I get paid monthly. Kristen is twice a month. So what I do is have separate sub accounts set up to where, I know that there's some fixed expenses. And I just immediately put those into, I literally have it titled, insurance or debt or whatever we're trying to do, to set it up in a sub account to do that, and then link it automatically to that sub account, because you have a separate number for the sub account, and then you just linked and you're good. And all you have to do is fill up your account at the bank once you get paid, and you don't have to think about it again. And then on top of that, obviously you can set up a separate account to link for investment accounts or whatever accounts you want. I know that our credit union offers, I don't even know, I think you can do double digit sub accounts, or I don't know, they'll always take more of your money. Let's put it that way. So that just really, really helps automate things. You don't have to think about it. You don't have to worry about missing bills or payments or anything like that. You just know that it's automatically taken care of. Then what's left over, it just goes into checking, or like we use rewards credit cards. So as long as that's kind of in line with the spending amounts and targets and things like that, doesn't matter. We can just spend what's left, because we know we have the peace of mind to know that we saved first and saved early, and so that it won't matter how much we spend, as long as it's within whatever's left over. And generally, again, from a human nature standpoint, that's the best way to do it, rather than the traditional way. If you said to me, well, I try to just save whatever's left at the end of the month. Well, how many times do you write yourself an IOU? Or how many times do you say, all right, next month I'll do double, right? It just doesn't work. We're just fighting human nature. So if we treat ourselves like a bill, pay ourselves first, right? That old mantra, and then spend the rest, you don't have to feel guilty about it, because you know that your goals are already accounted for. So it's pretty awesome. It's pretty helpful. The good part about reverse budgeting is it does not require tons of tedious tracking, and we already kind of have life planned in. If like I mentioned, you have to take extra Ubers, or you go out 2 more times in a given month with your friends to go to dinner or whatever, after you set up the automation, it's pretty simplistic in the sense that you don't have to put in a ton of maintenance. And then in addition to that, if you're focused on saving, then you don't have, or you can't really spend what you don't have, because it's not there. You just already saved first, and it's not like the goal. I mean, you could, but the goal is not to touch it after it gets saved. And if you are, like I met someone a few years ago that was like, yeah, we save a lot, but then we figure that we save, I don't know about too much, but we save in a way that we save a bunch early, and then we end up going back to it and depleting what we did save throughout the month. So really some fine tuning and adjustments might be needed, but that can get done month to month, which is awesome. So, just going back through my notes here and looking at what would make the most sense as far as setup and things like that, and pros and cons. The goal is to use human nature to your advantage and not against you, and also make sure that you have a system and process in place so that you don't feel guilty about spending any dollar over the course of a given month. As far as who this might not be a great idea for, it would probably be a lot of, or probably be people that have a lot of like credit card debt already. I think that should be prioritized first. But I mean, this is just, it's such a, at least it's worked for us. It's such a good way to do it. And so I mentioned that I'll go through, what we do. And I know I already spoke about it a little, but again, just as a summary here, I get paid once a month from the business, and then Kristen gets paid twice a month, and I have separate sub accounts that I set up. We look at how much we want to save. So she maxes out her 401k through work. I invest a lot back into the business, and then I also invest a lot into our taxable investment account. And that's just because that might be pinholed for something before retirement, or if we need to make a large investment back into the business at any given point, or if I want to buy another book of business or something. So we basically look at, okay, let's just save max out the retirement account and then save a bunch. And I set that up automatically. I like to do it immediately once she gets paid the 2 times per month, and then also when I get paid at the beginning of each month, we set it up to where it automatically does it. I have a separate account for the rent and mortgage, and then a separate account to pay the bills, whether it's insurances, debts, anything like that. And then the rest basically gets put on a rewards credit card. And, I'm just really mindful of that. Like, you could do it where you just spend on checking or debit cards and things like that. I like the reward factor. As long as I'm paying it off every month, or we're paying it off every month, it's totally fine. So that's our process. And then, we don't have to feel guilty about anything that we spent. So wrapping it up here, just in summary, right? Step one is to just figure out what you're currently spending and what your goals are, and put that into whether it's a monthly savings goal or a twice a month savings goal, and just figuring out where you want to be. Step two is to establish those accounts and make sure that you have sub accounts in place so that you can automate things and pay yourself first and cover your bills. And then that leaves you with an amount that's left over that, again, you don't have to feel guilty about spending. So I hope that topic is helpful. Obviously, any questions at all, I'm more than happy to answer. info@lifepointplanning.com. If you enjoyed today's show, please leave a review, a 5-star review on whatever podcast medium that you listen on. And I truly appreciate all the support. If you have any topics or anything that you want me to cover as well, send those along, info@lifepointplanning.com. And I'm looking forward to catching everyone next time. Thanks so much.